We had markets move higher yesterday. It was a pretty tentative recovery that we saw at first, the market off its earlier highs, but halfway through that market managing to surge ahead and the JSE finishing 3% higher. At this stage, we're trading back in negative territory, so safe to say that nerves have got to be frayed at this stage.
Absolutely, Alishia. It's, the volatility looks like it's set to continue. We're also going into a weekend, and I think even if the US was strong last night, local investors and traders are a bit loath to get into the market, particularly when we see whipsaw action in the international markets. And we tend to a large extent to follow what they're doing anyway. So the correlations are pretty high in the equity market. So it's understandable that investors and traders should be very cautious at this stage.
Of course, that's because we've got a fundamental picture that isn't going to change overnight, and that no matter which side of the Atlantic you're looking at right now.
Absolutely. There's no clear certainty as to what's going to be happening with the world economies going forward and what actions central banks and governments are going to take to try and remedy that. So with that question mark hanging over the market like the sword of Damocles, I think the strategy that we've always advised to have great diversification should help, well, should at least help people preserve capital at worst. And that's why we've been advocating the correct kind of asset allocation that we have.
Preservation of capital, that's the aim of the game right now. We've got diversifying a portfolio hot on the agenda. Kimon, how are you diversifying your portfolio?
Well, we reduced our level of equities down to 40% a couple of weeks ago, which we thought was fairly prudent. In the local market, we still like the bond market, but prefer the short end of the yield curve. We still like inflation-linked bonds, and as you know, we've got a heavy weighting there, at least 20%. Increase the cash holding from the equity sales, and that's where we're sitting right now. And as you know, we also like gold, so still 10% physical gold holding, which helps us with our currency diversification, really.
Taking a look at that gold price, we've seen some pullback coming to the fore, that taking the gold price off its record highs. Just where do you see this gold price heading? Because we had at a point seen it at parity and moving beyond parity when it comes to its relationship to platinum.
Absolutely. We like it as a currency diversifier. And if one looks at the amount of gold that's actually above ground in relation to the amount of currency that's been printed globally, it's minuscule. So I think demand for the metal is going to continue. It's anybody's guess. We've got a target around about $2,200, which we don't think is an unreasonable target. But at the same time, with the kind of moves that we have seen, it's understandable that there's a bit of consolidation, even a bit of a pullback is expected.
Well, let's shift focus over to the equity space, because you're not entirely off that space right now. You're just a bit selective in terms of which companies you're including in your portfolio. So let's take a look at some of the opportunities you're seeing emerge in that space.
I think there are going to be many opportunities over the next couple of months. We've seen the PEs drop quite dramatically, particularly in the US and European markets. We think Europe has probably got more value than the US and marginally less volatility in the equity space. If we look back a year, we saw the banks under a lot of pressure. Now it's actually governments that are under pressure with their with the kind of debt levels that they do have. And there's some really good companies that are particularly cash generative. That's what we'd be looking at. Defensive plays, possibly food exposure. Nestle is a good example of the international stocks that we'd be looking at. In fact, I'd probably like to hold Nestle debt as opposed to any of the government debt that's out there. So Nestle is a good all-round company. There is it's obviously a food company, which we like. We think resources are going to be really quite scarce. I think there's a shortage of food. I think their sales are going to be good going forward. So that's an international share that we'd like to hold. Locally, we'd be looking much the same. Cash generative companies that pay good dividends, that are on a reasonable PE. And I think you're going to have opportunities to buy those. Remgro's a very good example. Good management, pretty consistent, and largely one is able to forecast their earnings quite accurately. So that's really a good company for us, and it's a diversified company, which is very important in itself. The diversification is important, and I'd say a reasonably large holding of that would be quite suitable for a portfolio, particularly as it trades at quite a discount to its net asset value.
Well, it's certainly a stock that has popped up on the radar screen of many investors where, the view is that it's low risk and it gives you a valuable place to hide, so to speak, in the current environment. But we have seen a shift in the fact that, Remgro's interests are in South African businesses. And so that volatility or that risk profile has increased somewhat without the offshore stabilization that BAT had provided at one stage of the game. Is that at all a concern for you right now?
Well, I think the risk in equities is always large, and I think it's always underplayed, sadly. Equities are risky, and at the end of the day, one should be demanding a higher return from taking on that higher level of risk. But if we look at that equity space, and I'm a great believer in, as you know, in diversification, which means that you do hold asset classes that you think will possibly underperform the others, but to a lesser degree. And within that's why we do like the diversified plays. We like the fact that it's at a discount. So I'm not too averse to that. You've got the BATS component. In fact, BATS is a great company, going to carry on generating cash as long as there's smokers on the planet. And pays a good dividend as well.